So have you wondered if it is possible to tap the equity in your home? You have this home in San Diego, you've got a bunch of equity, and you're wondering if there's any way to get to it because maybe you're tight on cash. Maybe you're looking to remodel, you need a few bucks here and there. You know how much remodeling costs, but it's really time to do it. And you just don't have enough cash. Well, here to talk about tapping equity, about getting the right size home, about right size purchasing, we've got the mortgage expert for Word on Wealth, and that is Shanne Sleder. He's our mortgage advisor. He's our mortgage editor on the Word on Wealth. To get a hold of him directly as you listen to the show, just remember his number, 858-683-1716. Shanne, how you doing today?
I'm doing good, Gary. How are you?
Doing great. I always love our conversations because it comes up at least twice a week with somebody saying, I have all this equity or I have a mortgage and I don't know what to do. And I just go, just call Shanne, have a conversation with him. But reverse mortgages are scary. I go, they shouldn't be. And I understand there's a lot of weird feelings about reverse mortgages. And I just want you to take the opportunity to start this show and just get rid of some of those myths for us.
Right. Well, first off, there's multiple ways to access home equity, right? There's traditional cash out refinance. We've got HELOCs. We've got fixed rate seconds. And then we have the home equity conversion mortgage, the reverse mortgage. And that obviously is what we're going to be talking about today. But, one of the things that when we're looking at a situation for a client is we will look at all of the different options, and based off of that client's particular situation and needs, we are going to look at which is best for that client and what they're trying to accomplish. So, one of the things that we always hear about HECMs or home equity conversion mortgages is the fact that you have to have your house be free and clear in order to use a reverse mortgage. And that is not the case. You can actually have a loan on your property and use the HECM to pay off that loan. And that's one of the best scenarios that we have, is where we've got seniors who are continuing to make home payments. And, there's really a more efficient way to use their money now. Instead of continuing to pay down that equity, to actually reverse it and start to use that equity for their benefit and no longer be making those payments. And now not only do they have potentially more money available through the reverse mortgage, but they also no longer have a monthly payment that they're required to make. So that's one of the common myths. The other one that we hear all the time is that, if you use a HECM, that you're going to be turning your home over to the bank. Any remaining equity that you have in your home, when you either decide to sell or when it goes to your heirs, is going to be going to the bank instead. And that is not the case. You continue to own the home. If you have the home in your living trust, it is going to continue to be in the living trust. It's going to go to either you or your heirs, however you designate it. And in most cases, when we run our projections with the great appreciation that we have in San Diego, there's still going to be equity left over. Now, it's not going to be as much as you would have had if you did not do reverse mortgage, but there's also an opportunity cost there where you were having to use that money to do other things. You were not allowed or able to, you weren't able to use the money for, paying off credit card debt or home renovation that you needed, and you were having to tap into your retirement account instead. So it gives you a lot more flexibility.
And you talk about that, and it's very interesting. I want to kind of emphasize that a little bit. Other option is you tap your retirement account, but that's a taxable transaction. And depending on how much money you have and all that, some people, they don't have any tax obligations until they start tapping their retirement account. And when you go and do something like a home remodel or a kitchen remodel, you're not talking about, $5,000 or $10,000. A lot of times it's a fairly hefty expense that adds value to your home. It adds, potential equity in your home. And yet I do see, like you're saying, some people are saying, well, you know what, that my IRAs or my 401k has been sitting there for a long time. I'm just going to go ahead and pull out, $50,000 or $40,000 out of the IRA And to which I'm, just like going, no, because that's going to put you up into a higher tax bracket. Even if you're at the zero, you're going to be in a tax bracket and you're going to pay federal and state. It's just such expensive money. And yeah, and the thing is, even if the reverse rate, even if the mortgage rate were like 6, 7, 7.5, even like 8%, even if it were at that, it's still, it's way cheaper than the tax rate, because if you start pulling it out of your retirement accounts, there's a huge big penalty as far as taxes go. So yeah, I love this, tapping equity, because we have been so blessed in San Diego that our homes just increase in value, and we just have this big pocket of money sitting there, and yet you can tap it. And I like the way you're talking about it. So, and those are the two big ones, right? Lose your home, got to be free and clear. Neither of those are right. You can do a reverse mortgage either way. You're not going to lose your home.
Those are the big ones. Also, the fact that only one of the borrowers has
2 minutes.
A lot of people think both borrowers need to be age 62. So you can have one spouse be younger. It will affect how much money they're able to get, because it'll go based off the younger age. But it is still a potential to be able to do a HECM in that situation. And just going back to what you were mentioning with the retirement account, the other thing is, not only are you hit with that huge tax when you take the money out, but you've now forfeited all of the potential growth that would have come on those funds that were going to be in that account for the next 10, 15, 20 years, because it's now been withdrawn. You're not going to be able to put that money back. Whereas if you use another source, whether it's a HECM, whether it's a cash out, traditional loan to tap into your equity, you now have that money in your retirement account continuing to work for you and compounding for you. And we all know that the biggest benefit of investments is the strength of what compounding does for you.
Absolutely. Absolutely. And the thing that I want you listeners to really be picking up on this is, when you deal with Shane, you deal with a professional that is going to give you your options. You'll meet with him. He's willing to meet with you and a financial advisor, you and a family member, you and a witness, you and your tax professional, to talk about your options available. And there are just a lot of options available. It's not like he only does reverse mortgages, only does forward mortgages. He does all this, and he will explain it to you and give you your options. That's what I love about Shane. That's why my clients really appreciate him. You're listening to The Word on Wealth. You got Gary Quackenbush and Shanne Sleder, who is our mortgage advisor. And when we come back, we're going to talk a little bit more. We've got some things about the market conditions are changing, and Shane's going to talk about that when we get back right here on The Word on Wealth.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to The Word on Wealth with Gary Quackenbush. We are here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com, 855-500-TRUST. You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is Faith-Based Investing with Anthony Wright.
Most Christian families don't understand this one thing. The money that you're saving for retirement helps fund the abortion industry as well as other liberal anti-family causes. It's the sad, dirty little secret of American investing world. And here's the good news, though. You probably also didn't know that just a few minutes of your time, and we'll screen and clean your investments for you. There's no cost, no obligation. Learn the truth about your own investment mix. Then the choice is yours. Remember, the word says when God's money is in the hands of the righteous, the people rejoice. Well, we also are fiduciary investment advisor representatives. That means that our firm makes a pledge to always act in your best interest. Go to BibleSafeInvesting.com. Download a free copy of my book, Faith-Based Investing, or call me at 931-RETIRED. And please don't forget, listen to Faith-Based Investing this weekend right here on Family Talk.
Gary, how do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free initial consultation. That's gqlaw.com, 855-500-TRUST.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of The Word on Wealth. You hear Ken every week here on The Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group. From single-family attached homes to luxury high-value waterfront properties to apartment buildings, Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com. Or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
Oil investment.
Ask for the legal help you need. Call Gary and the team at GQ Law, 855 books and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's GQ Law.
But our friend and mentor, mortgage advisor, Shanne Sleder, on the show to appreciate all the information that you're sharing with our listeners. And hopefully they will tell their friends and family that, hey, this guy actually knows what he's talking about. He's going to give us our options available. And I just love that. What I would, can you give us an update? Because there's some current trends that are going on. I know you'd mentioned the Fed threatens to raise them and then draw. It's like so many things. So help us understand that and the effect that's going to have on our ability to do HECMs or HELOCs and that type of thing.
Yeah, so a couple different updates are happening in the market. We have started to see interest rates come down on long-term mortgage rates. We're now down in the mid 6% range, and we were up at in the 8 and right around 8% just a month and a half, 2 months ago. So that's been an improvement, and that's because inflation has been coming down, and the Fed has started to say instead of increasing their short-term Fed funds rate, they're going to start to keep it level and maybe even decrease it sometime next year. And so the bond market's then reacting favorably to that. So across the board, whether you're looking at a traditional purchase loan, line of credit, or reverse mortgage, the lower interest rates are going to help. The other thing that just was announced is that every year around this time, they talk about what is going to be the new lending limits across the country for different types of loan programs. And because we've continued to have appreciation this year, even when a lot of people thought that home values are actually going to go down this year due to the high rates, nationally, they actually still went up, and locally they went up. And so we've had new higher lending limits announced across the board as well, which is going to help people to be able to borrow more with the higher valued properties. Now, where it really helps seniors who are looking for a reverse mortgage, or maybe they already looked at a reverse mortgage 3 months ago, 6 months ago, and because of the old lending limit and because of the higher rate, which both have a factor as to how much money you can get, maybe they weren't getting enough money to pay off their current mortgage, and they were going to have to come in with 30 or 50,000 that they didn't have available to extinguish that mortgage, or maybe it just wasn't giving them enough money to make sense for them to do, and so they decided not to move forward. Well, now with the combination of the lower rate and the great news is that they increased the lending limit from $1,089,000 up to $1,149,000. And what that means is they now will take into consideration a home value up to $1,149,000 when they're starting their calculations as to how much money you can get. So that's about a $60,000 increase. And if through a reverse mortgage, you're able to get 45 to 50% of the home value right there instantaneously, somebody who has a home value, up above $1,149,000 is going to get an extra $30,000. And then if you can combine that with the fact that the rates have come down about 1.5%, that might be another $20,000 or $30,000 that they can get. So now all of a sudden, somebody is able to get another $60,000 that just 3 months ago, 6 months ago, they weren't able to have access to.
And so, Shane, on that money, so let's say that's the case, they now with the lending limit has gone up, the rates have come down, so there's more money available, and they get an extra, $30,000, $40,000, $50,000. All of that, if you're dealing with the home equity conversion mortgage, all of that could be available in like a line of credit ready to be drawn out, or that's paid out to them monthly. Is that how that works?
Mm-hmm. Yes, it could be available to them in multiple situations. So if they've got a large mortgage to pay off and they need all of that money just to pay off that mortgage, then it would come out of the lump sum to extinguish that forward mortgage, and then they'd no longer have a payment on it. If they don't have a mortgage or they've got a much smaller mortgage, any money that's left over would be available to them to take some as a lump sum. Some could be just in a line of credit where if they ever need it, they can borrow against it, or they could set it up to have monthly payouts to them based on how much money they need. And then again, like we talked about earlier, it's always tax-free. Anytime you access the money, it's tax-free. So you may not even have to access as much as you were before from your retirement account because of the fact you're not paying taxes on it.
That's so interesting. Now, the other thing when we were talking about we have the loan limits, we have the interest rates, and then in addition, we also have that home equity home values are continuing to go up. Can you explain to us about if you're looking at a reverse mortgage, and let's say somebody is into a reverse mortgage already, they got the certain amount that they were allowed. You've said before that as the value of the house goes up, that you can make an adjustment or that loan will adjust.
Well, so there's two different aspects that we can look at here. One is if somebody did a reverse mortgage a number of years ago and they did it when they were younger, and all of a sudden the home values have gone up and they didn't really tap into a whole lot of it initially. Now you could look at refinancing that reverse mortgage into a new reverse mortgage with the higher lending limit, which will potentially give them more money to access or have in their line of credit. So that's one option. The other option is, regardless of what happens with the home value or with interest rates, if you have a line of credit as part of your reverse mortgage, which I always recommend that clients have, there's an internal growth rate that's part of the program that's guaranteed, where that money is going to grow every year, where you can now borrow more against the value of your house. So that isn't even affected by the fact that the home value is going up. You automatically get that. But the nice thing is if the home value is going up as well, then that just means there's more leftover equity for you or your heirs in the future.
Interesting. These are home equity, line of credits, HECMs. It just seems there's so many moving parts that's why I really enjoy, talking about them, because it's not just like this one thing, like, okay, this is the way it works. You take out 45% of your equity and you're done and you spend it. I'll tell you a little bit of a situation. I'll have you respond to this. There was a concern that this is a client, this was several years ago, and the children's biggest concern was that mom would get a line of credit and that she would take out all of her equity and immediately used it all for like remodeling things that she didn't really need to, because the mom understood, and I don't know, this is probably not really good advice, but she got this line of credit and she took it all out, the whole thing, and she put it into her checking account. And it was like 300 and something $1,000. So she stuck it all in her checking account. So then it's almost like, oh, I have a big account balance. And she just ended up spending it on things that didn't seem like she really should have. But if you look at that and then compare to what you're talking about, like you don't pull it out until you need it. So can you contrast the two a little bit?
And there are some safety precautions put in place where there's only a certain amount that a client can access in year one. So they can't take it all out right off the bat. They have to wait 12 months. But this is where the importance of having an advisor in place who can give guidance and can be looking at what's happening with the accounts and the investments and everything, and we'll tell them, it doesn't make sense to pull this money out and invest it or just sit it in a checking account, because now all of a sudden you're accruing interest on that. So educating the clients upfront, the family upfront, on the best way to utilize these programs is really what's most important, and why it's important to work with somebody who is a reverse mortgage expert like myself, who has worked on these for 17 years and understands the inner workings of the way that these programs operate.
I think, Shane, talking to you about this is so cool, because there are a lot of organizations, companies, people out there that do these type of loans that I think are pretty irresponsible. It's like, get as much as you can, take it out. Like there's just not a lot of consulting with it. And what I've appreciated about your approach is really the consulting part of it, where does this fit your situation? Is a reverse mortgage right for you? Is a forward mortgage right for you? Can you purchase, is it a good idea to try to purchase with a reverse or purchase with a forward? And then you're talking about the ways to draw it out and how to access that equity and do it in a way that's responsible, and getting other people involved to help kind of control that. And I think that's just really super important. If people want to get a hold of you, if you want to get a hold of Shane, it's 858-683-1716, 858-683-1716. Shane, let me ask you, do you still have copies of the reverse, the HECM guide available?
I do. And
Okay.
yes, all that needs to be done is they can just text the word reverse to the same phone number, 858-683-1716, and I will send out a reverse packet and guide to you so that it will give you some information. And we can also set up a one-on-one consultation, either by phone or in person. The nice thing is I am local, so we can definitely meet in person, either at my office or at your house, to go over. And, really what happens is as we talk with clients and they see the extra cash flow, the reduced stress from using a HECM, the freedom in retirement, that's when they really start to see the benefits and it becomes real to them. And so, what I just say is, if these are anything that we've talked about today just kind of hits where you think, I really should be looking into this. It's been something that I've been considering for a long time. We're running
1 minute.
Finances are tight. I'd love to sit down with you and go over, how a reverse mortgage could benefit you, and help you in retirement.
And I recommend Shane very, very highly. He does a great job. Clients love him. He is a consultant. He is an advisor. He will help you out. Give him a call. Give him a try. 858-683-1716. If you want that HECM guide, get it. It's free. 858-683-1716. You can get a hold of Shane Sleder. Shane, thank you very much for being with me today as a partner on my show every Tuesday. Really, really appreciate it. All right, guys, call Shane, 858-683-1716, and we'll be back in a minute. Thank you, Shane.
Thank you.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com.
Have today's economic conditions and high inflation made it difficult for you in retirement? Hi, I'm Shanne Sleder, the mortgage advisor on The Word on Wealth. You hear me with Gary Quackenbush, answering your questions every Tuesday at 2 p.m. For over 20 years in San Diego, I've specialized in home financing solutions for seniors as they get older and their families. If you qualify, a reverse mortgage allows you to convert part of your home equity into either a lump sum, line of credit, or much needed monthly income. You're insured and protected against ever owing more than the value of your home. And you don't have to sell your home, give up title, or get new conventional mortgage financing with monthly payments. The program is designed to make it easier for seniors to qualify. I will walk you through every step of the process. To receive a free reverse mortgage guide by mail, text REVERSE to 858-683-1716, or give me a call on my direct number, 858-683-1716.
Licensed with the state of California. NMLS ID number 239958. DRE number 01174642.
To request your free initial consultation or to talk with a member of the team, call Gary at 855-500-TRUST. GQlaw.com.
Shanne Sleder, you just got to remember that number. I give you these numbers of these professionals because I really think it's a good thing for you to get advice. It's like when we are talking about anything to do with mortgages, whether you're buying a home and you need a mortgage, whether you're trying to refi because you got a loan because you had to, and it's 7.5% or 8%, and you want to think about, can I get into the 6.5%? You know, is my equity down? Can I get rid of PMI and whatever? That's stuff you can talk to Shanne Sleder about. His number, 858-683-1716. You can also, if you really like to be online, go to San Diego SanDiegoMortgageNews.com. That's another way to get a hold of Shanne, San Diego SanDiegoMortgageNews.com, and get his free guide, free, 858-683-1716. Switching topics to putting money in your estate plan. So you've been financially responsible. You feel really good about it. You got your living trust set up. Hopefully it was my office that did it, but either way, you've got your estate plan set up. So we are here on the Word on Wealth very proud of you for getting that work done, because it's super important now to make it valid, because an unfunded trust is actually not valid. Okay, so you got to put something in it. The starting thing that you do is you put in your real property. That's done with a quitclaim deed. Quit, like giving up. Quit is actually you're basically quitting your claim, transferring to somebody else. So we typically use a quitclaim deed. You can use a grant deed. You don't use warranty deeds, but you can use those too. So what happens with a quitclaim deed is you're just basically transferring whatever interest you have under the back into the control of that success or the trustee of your trust. It's not directly transferred to your trust. I say that most estate planning attorneys do. We use we just say it probably a little too casually is, yes, put your house in the trust, transfer your house to the trust. It does not get transferred to the trust. It gets transferred to the trustee of the trust, because you're the trustee initially. And when you die, the next person in line after you, that next trustee, is called the successor trustee. The trust document provides that the successor trustee and trustee, that they can be used interchangeably. So that way, when you die and your successor trustee is in place, if the title to the house was transferred to you as trustee of your trust, that means that your successor is going to step into your shoes after you die. So they can now transfer the house, transfer it out to your beneficiary, put it up for sale, whatever they're directed to do in that trust document. But it has to be deeded in the trust. I've been asked many times, I've received calls from clients saying, "Hey, Gary, I got another house, or we bought a new house, and we want to put it in the trust. So does that require an amendment?" No, it does not. Putting a house in the trust requires a deed. Often you can convince the title company that's doing the escrow of your new property, or that's doing the, completing the document and paperwork for refinance. You can convince them to put it in your trust. And if they word it right, it's going to be you, trustee of your named trust. If they won't do it, then you got to hire somebody like me to get it done. And we're always happy to do that. Do it a lot. Funding trust with real property. What about if you have something like a mobile home? Mobile homes are a little bit different because sometimes you own the dirt under the mobile home and sometimes you rent it. If you're renting it, that means you're probably in a mobile home park. If you're in a mobile home park, then you don't have title to the dirt underneath your mobile home. You simply have title to the mobile home itself. And there's two ways you can hold title. One is a housing and urban development registration. It's like a title. It's like tan colored paper, 8.5 by 11 almost. And it describes who owns the property. The other way is it could be registered with the Department of Motor Vehicles. I just talked to a lady the other day and I was saying, "Are you sure it's the DMV?" "Yes, Gary." "Are you sure it's the DMV?" "Yes," because nobody registers it with the DMV. And she said, "Well, we did, because it's possible." So they have tags and license plates on the mobile home rather than a title. That works too. Okay. What you do, though, is if you look at that title and it says on there your name, under it your address as the owner, that is not in your trust. If you look at the title and it says your name, comma, trustee of the your name trust, it's in your trust, because that's what it takes. It's a title transfer. If you have then a mobile home and it's not in your trust and you don't know how to do it, there's a bunch of paperwork to do the transfer. It's a little bit of a challenge because you're having to work with a different department, but it can be done. And we do things like that when we set up trusts. We do transfers to mobile home, or mobile home transfers to trust, and we can do all kinds of other transfers, which we're going to keep talking about on this show. If you have questions for me, I would love to hear from you. 888-344-1170 to be part of this show and ask me your question directly. You don't have to wait to hope that I get to answer your question, go ahead and call. Give me your question, 888-344-1170, and Todd will answer, and he will be so kind to you, and you'll be so glad that you called because you get to talk to Todd. And if you're happy talking to Todd and you don't want to talk to me, I understand. He's got a better voice. Okay. So that's how you put a house in the trust. The next thing we're going to talk about putting in the trust is a rental, like a commercial property. So you have a commercial property, whatever, a house that you're renting out, single family, duplex, triplex, quad, quint, whatever, small apartment building, real property that you rent out to other people. Okay, there's two things. One, you have a lot of liability exposure with the rental property. You got to insure it and make sure you have enough insurance. Make sure the limits on your insurance exceed the total value of everything that you own. Because if you insure, let's say you
question about her trust.
Let's say you have a okay, we're gonna come back to that in a second, but we're gonna take a call now. We got our listener, Diana. Diana, welcome to the Word on Wealth. How are you doing today, Diane?
I'm doing great, Gary. Thank you for taking my call.
Absolutely. What can we do for you today?
Okay, I have a trust, and everybody I know has a trust. And a friend of mine from church who took care of her aunt, for she was her aunt, so she was related to her. Her aunt passed away, and she took care of her for a good 5 years. And there's a situation where there was a gentleman renting from her aunt. She had a triplex in Pacific Beach. And basically, this gentleman has basically lied and said that he should have been in the trust and he wants half the property, and he did all kinds of repairs to the property, et cetera, et cetera. And basically, I've never seen one person tell so many lies. So my question, Gary, is when you do a trust, why does the judge listen to everybody's maybe truth, maybe lies, and why don't they just say, look, the person that died wanted, in this case, Sandy, to receive all of her aunt's property, real estate, bank account, and this other person
2 minutes,
some money in the trust. And the reason for that was the lady that was her aunt used to have two roommates. One of them had a gay relationship with this gentleman's mother. That lady passed away years and years ago, 12 years ago. And the lady who died, the aunt, went ahead and left him $200,000. But he doesn't want the $200,000. He's got an attorney and he wants half of the triplex in Pacific Beach. So my question is, when does the judge just simply look at the person's will in the trust and grant the will, the wishes of the deceased person?
Well, I think the judge, I mean, when you get into probate, the judge is trying to determine what the person's actual intention was. So if you get somebody that's coming in and contesting, and it's a legitimate contest trying to say, hey, this isn't what they meant, this isn't the right document. I mean, first of all, they're going to be subject, they're going to have to watch out for a disinheritance clause. But that's what the probate process does. If the trust isn't done like super, if it's done well, then it's going to be defendable, and and you'll be okay. If the trust is sloppy or has questions, then sometimes you can question it. If it had a disinheritance clause, I'm surprised he's not getting tossed out. But that's the probate process. It gets kind of scary. But you know what? Diane, we're gonna have to take a really quick break. If you want to hold on through the break, it'll be like a minute or so. I can finish your question right after, or you can hang up and I'll give you the rest of the answer.
I'm going to go ahead and hang up, Gary. Have a great day. Thank you.
All right. We're going to continue talking to Diane right after this break, right here on the Word on Wealth. Did I mess up on the timing on that?
No.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
So, Gary, we've talked a long time about estate administration. So, what is that, and why is it important?
Estate administration is the distribution part of estate planning. So when someone passes away and they leave money to beneficiaries, the property has to be administered. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually you're going to have a successor trustee that's named in the trust. They'll have no idea what they're doing because they've never done it before. So then they call on GQ Law and we walk them step by step on how to be a successful and good successor trustee. We also do the required notifications. We notify the Department of Health Services and all the legal requirements so that they can have the estate administration done properly. We help successor trustees be successful.
Call or click to request your free consultation. GQLaw.com, 855-500-TRUST, GQLaw.com.
Imagine you're a lonely single teenage mom saying to yourself, I have nothing for this baby. Imagine trying to survive and struggling just to put clothes on your newborn. Right here in San Diego County, a volunteer outreach organization collects and distributes new and gently used clothing, blankets, and more. And it meets the heartfelt needs for community, dignity, and hope. Discover Gently Hugged. Learn more. Give and volunteer now at gentlyhugged.org.
We've heard so much about the hearts of young professional athletes suddenly stop.
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855-500-TRUST.
All right. Welcome to the Word on Wealth, where I'm finishing up Diane. Thank you for calling, Diane. Really appreciate it. We're going to finish up answering her question. So the situation is her friend's aunt had a triplex in Pacific Beach, and a tenant that was there for a very long time now was gifted $200,000 in her estate, and now he's going after more by taking it to probate court. And her question was, can't the judge just say, you got your 200, get out of here? Here's the thing with courts. A judge is a neutral person, and the judge is not allowed to make any opinions, because that would actually be kind of a breach of etiquette and a breach of the law. So what happens is the judge, we just consider them a neutral, uninterested party, and you have to convince the judge that your position is the better of the two positions, okay? So in this situation, if first of all, if somebody comes in like that, I mean, this is classic, the way Diane's describing it, it's a classic contest where this person is coming in and saying, hey, I should get more, I should get half of the property. That's a contest. And usually with the trust contest, there's language in the document that says that, if somebody conspires with someone or hires an attorney or goes to court or does some legal process to try to contest the trust, that they're going to be considered as disinherited. The problem with, and I don't know if this particular case, but a lot of trusts don't have a very good disinheritance clause. They just have some old crummy one. And in California, the law is like super well developed around disinheritance clauses. So if all the clause says is anybody who can contest this trust gets $1, that's super old school. Anybody that contests this trust is going to be treated as if they were disinherited and didn't have any children at the time of their death. those disinheritance clauses don't really do it, because in California, a disinheritance clause needs to describe to the disgruntled person what a trust contest means. You can't just say, if you contest this trust, you're out of here. It doesn't say that. It has to be specific. A trust contest meaning, and it explains, you can put in some very robust disinheritance clauses that explain, this is what I mean by a disinheritance. If you do the following, then you're considered as having contested the trust and will be disinherited. And it explains exactly what that is, that they hire an attorney, that they hire an attorney as a group, that they hire an attorney to question the trust, that, that they take some legal procedure, that they're, writing documents out, they're writing letters. So there's all different levels, but in California, you have to be very specific on a disinheritance clause to basically properly inform the contesting party that they are actually contesting the trust. So we don't know the situation with Diane's friend. It's a really unfortunate situation to have to go to probate court, but the guy that's contesting, he's going to have to pay for his own attorney's fees by himself. He doesn't get covered. The trustee who's defending the trust is able to use money from the trust to defend. Now, when you get a defense like that, if coming to find out he was being frivolous, or he didn't have a claim, or he's just, basically doing it to be a pain and to be, to cause problems or to cause harm, then the judge could actually award that his $200,000 gets reduced by the amount of attorney's fees that the trust had to pay to defend against him. And that just depends on how the battle goes. So trust contests are a big deal, but you've got to get the trust right. So when I'm looking at a trust, the one thing I want to know is there any possibility of contest? And if there is, because you're disinheriting someone, or because there's somebody's going to get, $50 and the other one's going to get a house, those are ones that's kind of classic, really annoys beneficiaries, and they tend to fight. So when I need to, I will put a much more robust, lengthy disinheritance clause and anti-contest clause. And those are things to be careful of. So if you look at your estate plan, like Diane was saying, she has, and all of her friends have trusts, which is so cool. It's like, hey, happy day. That's awesome. I hope they look through their trust and see whether first they say what they think they do, like who is the successor trustee and who gets how much money or what percentage. And number two, that it meets all the legal requirements, like, is it a spendthrift trust? If there's retirement accounts involved, is it a retirement protection trust? If there's a possibility of a contesting party, then is there a proper disinheritance clause or a no contest clause? So those are some of the things to be looking for to make sure that the trust is actually solid and tough enough so that it can withstand having to defend itself through the successor trustee. All right, so hopefully that explains it. And it's no shock to anybody that's listening that when there's money involved, there's greed. It just happens. People think, oh, what's the harm in fighting about it? You can get somebody that talks you into, hey, if you give me $10,000, I'll sue these people and get you half the estate. And then $50,000 later, $70,000 later, you still don't have what you wanted. Then you kind of go, hey, wait a minute, did you lawyer, did you actually think you could get me this? Or am I just being kind of burned by having to pay so many attorney's fees? You got to be careful. You don't want to fight what you can't fight. You want somebody to give you an honest opinion on if it's a fightable battle. And if it doesn't make sense to you, if somebody's telling you, oh yeah, you can win the store on this, or you can kick him out of his home, or he's going to be on the street and we're going to go after your brother and we're just going for a bloodbath. You hear stuff like that. If it doesn't make sense to you, first of all, if it sounds to you like it's going to totally destroy any, modicum of relationship you had with your family, probably should steer away from it. And if it sounds too good to be true, or almost too aggressive, almost just like, that's just doesn't make a lot of sense, then steer away from that. You want to make sure if you're going to contest a trust, if you're going to ask questions about it, if you're going to challenge something that you just don't feel right about, there's a way to do it without getting disinherited. So be careful with that. Okay, funding a trust, making sure that money is in there. Because remember, if money and things are not in the trust, then the trust could potentially not even be valid at all. So First thing is to make sure your house is in there. Then we're going to look at other buildings. So if you have a rental property, kind of like Diane's caller, triplex in Pacific Beach, I would hope that that triplex was owned by an LLC and that the LLC was owned by the living trust for a myriad of reasons. I'm a big fan of rental property being owned by an LLC because it gives you that extra liability protection. Okay. Because if it's in the same box or the same bucket as your home and your personal assets and your bank account and your car and all your stuff, if it's in that same bucket and there's a lawsuit and insurance won't quite cover it, then the creditor can get into that bucket of your other property, which would be super unfortunate. So what I want is that the building, the property is held in an LLC, and that's the bucket. If insurance doesn't cover it, if there's some excess claim, then potentially that LLC is going to cover it, and it's not, that creditor can't climb over the LLC wall and get into your personal stuff. So it's just an added layer of protection. There's no guarantee 100% protection of anything, but just you just layer up. You do the best you can, and the more layers you put between you and a creditor, between you and a lawsuit, the better. It's just good advice and makes good sense. You have to calculate it out. Does it make sense if you pencil out the cost of doing it? Does it make sense? And if it does, think about it. And if you need help with it, just call me, 855-500-TRUST. We can work with you. We can set up LLCs, corporations, and do the transfers into your living trust. 855-500-TRUST. The one thing about an LLC I will caution you is if you have a property that you're going to put in an LLC, and let's say it's just owned by husband and wife, and they decide, hey, wouldn't it be nice on this rental property, wouldn't it be nice if our adult children they got some interest in it? We could kind of pass along part of it to them. And so then you decide, oh, I'm going to transfer, instead of going, so you have this house, okay, and then you're saying, I want my son and daughter to be part of it. So you create this LLC and you give the children some interest in the LLC. Like, let's say, they each get 5%, because you think, well, between the two kids, they own 10% of the LLC. That means mom and dad still have the say on things. And then you transfer a house or a rental property that's in the name of husband and wife. Now you transfer it to the LLC. Here's what you just did. You changed the title. It's a disposition of the property. It's like a sale. It's a change in title. It's a change in ownership. That change in ownership will trigger a reassessment by the county assessor's office. Why? Because it used to be, because before that property went into the LLC, it was owned by two human beings, and they own that property together 50-50. Okay. Those two human beings transferred that property to a limited liability company. That limited liability company equals 4 people. It's got the husband, the wife, and 2 kids. So there's 4 people that own that LLC. What you've just done is you've changed ownership of that property from 2 people to 4. I don't even care if the kids have a 0.5% interest or a 1% or anything.
2 minutes.
You change the ownership of that property. The county assessor is coming in to reassess. Okay. Unraveling it is really difficult. In fact, most of the time, the county assessor says, no, I don't care if you didn't know the law. If it's not a mistake, like oops, not that we didn't know, but we just, we didn't mean to as a complete accident. That's a different story. But they're going to look at it as that was a transfer. You intended to do it. You did it. Now it's going to get reassessed for property tax purposes, and that may cause a big problem for you. So just when you get into transfers of property in and out of trusts, in and out of LLCs, be careful. Have an advisor. Do not do it on your own, because you don't do it every day. Get somebody that does it every day. If you want me to be your guy, me and my team, it's 855-500-TRUST, and my law firm is GQ Law. GQ Law happens to sponsor this show, which I so much appreciate. Okay, so you have your LLC, you put that into your trust. You have your corporation, your business is owned by the corporation, you put the stock in your trust. That way, the successor trustee, if you become incapacitated or die, that means the ownership of the LLC, the ownership and management of the corporation, that belongs to the trustee. So they can wrap up the business, put it up for sale, rather than just letting it fall apart and just into disarray. So that's why I really am a big fan of LLCs, corporations, and then put those in the trust so that your trust is the trustee is the owner of the LLC, trustee is the owner of the corporation, and then the LLC and the corporation own the property. And it's a couple of layers. It makes it so that transfer is smooth. If you got questions about this, make sure you give me a call, 855-500-TRUST. And if you want a free book on how corporations and partnerships and LLCs work, go to my website, gqlaw.com, and get my free book called Accidentally Self-Employed. We'll see you tomorrow with Ken Pecos, everybody. Wednesday, Real Estate Day, coming up on the Word on Wealth.
Tell a friend about the Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. The information you hear on the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The opinions expressed here do not necessarily represent the views of Salem Media Group or its sponsors.
The airing of